When we see that the New Zealand dollar was the strongest currency last week and the Japanese yen was the weakest, we might conclude that the week was blessed with strong risk appetite. Indeed, it was to an extent, until markets reversed shortly after better than expected non-farm payroll data from the US. Friday's sell-off had the Dow Jones erase all of its gains in a hurricane-shortened week. Gold has indeed dived over 2% on Friday to finish below 1700 at 1678.4. On the other hand, the dollar index broke through its 55 days exponential moving average decisively to close at 80.59, the highest close since early September. It seems that the string of positive economic data released on Thursday and Friday was used as an opportunity to lighten up the position in risk markets ahead of the US presidential elections. Technically, rebound in the Dow Jones last week was corrective looking and has finished. The fall from the recent high of 13,661.87 is set to extend lower and would likely break through the 13,000 psychological level. Strength in commodity currencies was far from being impressive. Aussie dollar US dollar very briefly breached 1.04 and looks set to head back to 1.0235. US dollar Canadian dollar's retreat from 1.0019 was rather shallow and corrective looking. European majors were weighed down by stalemates in Greece and Spain, and the euro was indeed the weakest among them. However, European majors will likely stay in recent range against the dollar rather than break out in the near term. After brief volatility, the Japanese yen stayed weak after the Bank of Japan expanded its easing program. Though, the momentum in Euro Japanese yen and British pound Japanese yen was quite unconvincing. So overall, we'd slightly prefer to short Aussie dollar US dollar in the near term and keep an eye on stocks and gold to see if their respective sell-off continues. Should risk markets stabilize and rebound, which is not very likely in the early part of the week, we'd turn to a US dollar Japanese yen long. To recap, non-farm payroll report showed growth of 171,000 in the U.S. job market in October, much better than consensus of 120,000. September's figure were also revised up from 114,000 to 148,000. The unemployment rate edged higher from 7.8% to 7.9% as expected. The ISM Manufacturing Index unexpectedly rose to 51.7 in October. Consumer confidence also rose to 72.2 in October. The data has boosted market sentiment briefly. Talks of the United States fiscal cliff have heated up again as we approach the year-end. Although the actual expiration of the tax cut and activation of reduction in government spending don't begin until 2013, the country's economy has already been affected. If the government makes no concession and all Bush-era tax cuts expired as scheduled, this could extract as much as $600 billion from the economy, around 3 to 4% of GDP in 2013. The U.S. presidential election will be the main focus this week, and latest polls showed that Obama and Romney are almost tied, with Obama just slightly ahead in some swing states. The euro extended its corrective fall against the dollar last week on stalemate in Greece and Spain. After a conference call, the Eurogroup of finance ministers issued a statement urging Greek authorities to solve remaining issues so as to swiftly finalize the negotiations with the Troika institutions. And the officials emphasized that release of the next round of money was subject to the completion of prior actions by the Greek authorities. German Finance Minister Schäuble said that there are a lot of difficult issues that still need to be resolved, and the next report by Troika wouldn't be ready before November 11th. There is still no news about Spain's bailout, even though the upcoming European Central Bank meeting this week will be the second one after the OMT announcement. Spain's GDP contracted less than expected by 0.3% in September, compared to prior estimates by the Bank of Spain at 0.4%, also provided some support to sentiments. ECB Nowotny said that there is no need for an imminent bailout for Spain as the government is fully financed until the end of this year. And he said that the OMT is a program with very strict conditions, and he could imagine that this is one of the aspects that is on the minds of the Spanish government. Economic data from the UK was rather mixed, though this data was overshadowed as the Confederation of British Industry upgraded UK economic forecasts in its latest report. CBI projected that the UK economy will stagnate this year and grow 1.4% in 2013. That compared to August projections of a 0.3% contraction in 2012 and 1.3% in 2013. Also, growth is expected to rise further to 2% in 2013. CBI Director General John Crydland, though, sounded cautious and noted that the rebound from recessions was partly due to the Olympics and the economy is still vulnerable. He said that risks are on the downside. It's more likely than not that European policymakers will continue to do enough to keep the Eurozone together, but there has to be a risk that slows down global growth. Development in Euro-British pound argues that sterling could be the relatively stronger one among European majors in the near term. The Bank of England will meet this week and which will likely be a non-event. The Swiss National Bank said in its quarterly report that it lowered its euro reserves to 48% at the end of September. That's a significant drop compared to 60% at the end of June. Holdings of the United States dollar, British pound, Japanese yen and Canadian dollar were increased during the period. Bank spokesman Walter Meyer said that the drop in euro reserves reflect a rebalancing, which brought them down to our desired long-term level of around 50%. Meanwhile, the central bank also said it had profits of 16.9 billion Swiss francs for the 9 months through September, with a 94 million gain from franc positions and a 6.2 billion gain in gold assets. The Bank of Japan expanded asset purchase for the second consecutive month as a means to stimulate the country's vulnerable economy. Policymakers announced to leave the overnight call rate unchanged at 0.01% and will expand the asset purchase fund by 11 trillion yen to 66 trillion yen. It also decided to keep its credit loan program at 25 trillion yen. The move had been widely anticipated and there's still possibility that the central bank would add more easing early next year. China's manufacturing PMI improved to 50.2 in October, up from 49.8 a month ago, signaling the country's manufacturing sector returned to the expansionary territory. Components of the data also suggested that the government's monetary easing has fed through the economy. Meanwhile, the employment situation appears to be firm despite the economic slowdown. Going forward, we expect policymakers will feel less urgency in adding stimulus to the market, while the new leaders would likely maintain the current monetary stance.